Hi, everybody. Thanks for joining me. Before we get started, please click subscribe to my channel to keep up with all of my latest personal finance and investing content. And please check out the link you see on your screen for a message from my sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now.
I'm going to go with a company that everybody knows for my next pick, and that is Apple. Not the highest dividend yield. Again, 0.66% as we're recording this. But, I mean, what a business. $111 billion in free cash flow over the last year. They're just printing money, and I don't see any reason that that's going to stop. This is one of the companies in the tech space that reported pretty good results in the third quarter of 2022. And it's because, well, like, what are you going to do? Not buy a new smartphone, which is the device that you're probably on all day, use every day. You know, you can cut back on things like maybe Netflix because you have 5 other streaming services, but you're not going to not have a smartphone or a computer. So I think they're in a really good position as far as that goes. The services business is just another incremental add to me. And I think the value in this company is the ecosystem that they have. The smartphone is really the center of it right now because that's what the device that the most people have, but it makes Macs more attractive. It means that they now have the money to invest in making their own chips, which makes their smartphones and computers and AirPods a little bit better than the competition, integrate a little bit better. So it's like a business that's uncrackable by other tech companies. I don't see how this is a company that would be disrupted anytime in the next decade, unless there's something that completely comes out of left field like virtual reality. But I don't think that's the case right now. So I love the moat, not the highest dividend yield, but they're also, not paying out as much in dividend as they could. They're buying back a lot of stock. So that means you own a bigger and bigger percentage of the company over time. I think we'll also see that dividend yield rise over time. So maybe 5 years from now, you're getting a 4 or 5% dividend yield from your stock price today. So this is a company that I like partly because of what a big moat it has, and the fact that I just think Apple is going to be a mainstay for the foreseeable future. So why not get in on this dividend stock?
Yeah, I mean, Apple has probably the stickiest customer base I know of, and that includes companies like utilities because of their pricing power. A few weeks ago, I suggested to Travis that he might want to switch to an Android phone, and his face looked like he bit into a lemon. Like it's unfathomable for people who love Apple products to switch to anything else. And
it's impossible to switch. I mean, even if I wanted to, it would be a nightmare like all my stuff is in the cloud. My subscriptions are through Apple. It would just be, you talk about sticky, like there's a reason that it's so hard to get out of the ecosystem.
Yeah, I mean, and people want the latest devices. I mean, people will gladly absorb inflation for the newest Apple devices.
Exactly.
So, and that actually gives them an edge over other sticky businesses like utilities, because utilities prices are normally regulated. Apple can charge whatever it wants.
Yeah, and I think they still have a lot of room to raise prices if they want, as much as customers might not like that. All right, what is your next stock, Matt?
My next one is kind of a tech adjacent play that you might like. It's called Digital Realty Trust. Ticker symbol is DLR. This stock has been tremendously beaten down lately. It held up really well for most of the downturn, and most of its decline, it's down like 40% from its highs. Most of that happened in the past month or so. The reason is, you probably heard of the big short seller, Jim Chanos. He came out and said his newest big short idea, he was the one who called Enron's collapse. His big short idea is data centers. And his general thesis is that tech companies are going to start building their own data centers, and Digital Realty is not going to have any tenants. Now, that may be true for companies like Apple that have, more money than most countries do. But when it comes to these high growth tech stocks, they don't want the burden of real estate on their balance sheet. Companies like Datadog and Twilio, high growth tech stocks, they don't want that asset heavy model going on. So to put it mildly, I don't buy the thesis. Data centers have major growth tailwinds. The volume and sophistication of data flowing around the world isn't getting smaller. Big growth catalysts. I never thought I'd be able to buy this stock at a 5% yield again, but here we are. It is at a 5% yield. One of my favorite real estate companies and great management teams. And I just think the long-term tailwinds outweigh any customers that they might lose at the high end of the the tech spectrum. Like Apple, Microsoft, Facebook, sure, they could build out their own data centers. But the big growth players that need their capital for growth, they don't want to own real estate.
I definitely believe the argument that the smaller companies are going to still leverage these real estate companies that allow them to grow more quickly. My question for you is, what is the impact of higher interest rates on a company like Digital Realty Trust? Because that is a headwind, and that's not really something that's in their control.
It is. And like most real estate companies and most real estate investors, they finance a lot of their business with borrowed money. Most of their debt is fixed rate, and they have A credit ratings. They're very highly rated. So their borrowing cost is relatively low. That said, it becomes a difficult growth environment if rates stay high, because most of their existing debt is at fixed rates that they had when interest rates were low. But if they want to expand going forward and need to borrow money, especially with their stock price down, they don't want to issue new equity at these prices. It becomes more expensive to take on debt, and their properties their new properties would be less profitable compared to old properties that they could finance at 2%. So the interest rates are a concern, but from a long-term standpoint, this is just a powerhouse business. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.